The semiconductor sector is known for sharp cycles and sudden moves, both on the upside and the downside. In recent weeks, shares of Marvell Technology fell nearly 19% in a single day following its second quarter fiscal 2026 results. At first glance, such a steep drop may look worrying. But once we look deeper into companies' numbers, outlook, and positioning in the artificial intelligence and data center markets, the story looks very different. Today, I'll explain why Marvel's stock price went down, why that reaction was not justified, and why this correction creates a solid buying opportunity for both near term and long term investors. Marvell reported second quarter revenue of $2 billion, dollars, growing 58% year over year and hitting a record high. Non-GAAP earnings per share came in at 67 cents, also a record and up 123% from the same quarter last year. Gross margins were strong at nearly 60%. On almost every measure, these were outstanding results. So, why did the stock fall? The answer lies in expectations. Analysts had set the bar extremely high. Marvel's revenue, while up sharply, came in just about 10 million below consensus estimates. Its guidance for the next quarter at 2.06 billion US dollars was slightly below Wall Street's preferred number of 2.1 billion US dollars. In addition, management noted that growth in its custom chip business would be uneven across quarters. The investors immediately latched on to that short term commentary and ignored the broader picture. In effect, Marvell delivered record revenue, record profits, and gave guidance for 36% year over year growth in quarter 3. Yet, because it didn't beat already stretched estimates, the stock was punished. Nearly 13 billion of market value was erased in a single day. That is why many analysts and long-term investors called the sell-off an overreaction. The fundamentals of the company remains intact. In fact, they are strengthening. Let's look at the key points. First, data center growth is extraordinary. In quarter 2, data center revenue rose 69% year over year to 1.49 billion. This makes up about 74% of the company's total sales. More than 90% of this business is tied to AI and cloud demand. This means Marvell is no longer a diversified semiconductor company dabbling in different markets. It has become a central supplier to the global AI infrastructure build-out. Second, profitability is surging. Non-GAAP operating margin expanded to 34.8%, almost 900 basis points higher than a year ago. Net income on the same basis more than doubled to 585 million. Operating cash flow rose to 462 million. The company has achieved real operating leverage. Revenue is growing fast, but profits are growing even faster. Third, Marvell has sharpened its focus. The firm recently sold its automotive Ethernet business to Infineon for 2.5 billion in cash. This move achieved two things. It brought in significant capital to strengthen the balance sheet and fund buybacks. And it allowed management to fully redirect resources towards the much larger opportunity in AI and data centers. This is an example of good capital allocation. Fourth, design wins and pipeline are at record levels. Management revealed that it now has 18 multi-generational design wins for custom AI chips, with over 50 more opportunities in the pipeline. These represent an estimated 75 billion in potential lifetime revenue. Marvell aims to grow its data center market share from 13% in 2024 to 20% by 2028. That is an ambitious but realistic target given its position with hyperscalers. To understand why Marvell has such strong potential, we need to examine its products and positioning. Marvell is not making GPUs like NVIDIA or AMD. Instead, it specializes in custom application-specific integrated circuits or the ASICs. These are designed specifically for the needs of major hyperscale customers like Amazon, Microsoft, and Alphabet. These chips are optimized for power efficiency and performance in AI workloads. In addition to making custom AI chips, Marvell also provides the critical plumbing of modern data centers. Think of a data center as a giant city for information. The chips are like factories where work gets done, but you also need highways, power lines, and security gates for everything to function smoothly. That is what Marvell supplies. Its electro optics products act like ultra fast fiber highways, moving data at lightning speed between servers. Its switching products are like traffic controllers, directing data to the right place without bottlenecks. And its security modules act as the guards at the city gates, ensuring that only trusted information flows through. Without these interconnect solutions, even the most powerful AI chips would sit idle. During the quarter, Marvell began shipping its new 1.6 terabit PAM DSP chips. These are advanced optical chips that help move huge amounts of data quickly and efficiently inside AI data centers. The company also started ramping up production of its 51.2 terabit switches, which are like the ultra high capacity traffic controllers. These direct massive streams of information without slowdowns. On the security side, Marvell expanded its collaboration with Microsoft Azure. They're now supplying hardware security modules that act as digital locks to prevent sensitive data in the cloud. Beyond current products, Marvell is also pushing the technology frontier. It announced breakthroughs like the world's first 2 nanometer custom SRAM for AI workloads. SRAM is a super fast kind of memory that sits right next to the processor, letting the processor access data instantly without waiting. Marvell also announced a 64 gigabit per wire die to die interface. This allows chips inside a system to talk to each other at incredible speeds. Put simply, these innovations mean Marvell is not just keeping up with the industry, it is helping set the pace for how the next generation of AI data centers will be built. Management estimates that the total addressable market for the data center chips will grow to 94 billion by 2028. Marvell's aim to capture 20% of this market translates to nearly 19 billion in potential annual revenue. Compare this to just over 2 billion per quarter today. While the data center is the growth engine, it is not the only part of Marvell showing improvement. Enterprise networking revenue grew 28% year over year in quarter 2. Carrier infrastructure sales went up 71% compared to the last year. Both of these areas had been weak due to excess custom inventories, but they are now rebounding as demand normalizes. Consumer revenue, while a smaller part of the business, jumped 84% sequentially thanks to gaming demand. Consumer revenue refers to the sales that Marvell makes from chips used in everyday consumer products such as gaming devices and other electronics. In the latest quarter, this part of the business surged 84% compared to the previous quarter, mainly because demand for gaming products picked up strongly. Taken together, these markets provide a diversified base that adds stability to the business. One of the strongest arguments in favor of buying Marvell now is its valuation. After the correction, the stock trades at about 18 times forward earnings. Its price to sales ratio is 5.7 compared to an industry average near 7 and a historical multiple of 8. Its price to earnings growth or PEG ratio is only 0.64. By any traditional measure, this is an extremely cheap valuation for a company growing revenues nearly 60% year over year and more than doubling profits. Analysts have price targets ranging from $90 to as high as $130. That implies potential upside of 40% to 100% from the current levels. Independent investor articles echo the same view. Marvell's fundamentals are robust. The sell-off was emotions driven and the stock is now trading at a discount. Looking ahead, there are several reasons to expect both near-term and long-term gains. In the near term, quarter 3 guidance points to 36% year-over-year revenue growth. Non-GAAP EPS is expected at 74 cents, slightly above consensus. Management also expects quarter 4 to be substantially stronger for its custom business. This refers mainly to ASICs, application-specific integrated circuits. These are Marvell custom designs for hyperscale customers like Amazon and Microsoft. These chips are built for very specific AI and data center tasks, making them more efficient and harder to replace. Because demand depends on each customer's rollout schedule, revenue can look uneven from one quarter to the next, but the overall trend points to strong long term growth. This suggests the dip in growth is simply a timing issue and not a structural problem. In the long term, the AI and cloud build-out remains in its early stages. Hyperscalers are investing billions in infrastructure. Marvell, with its custom silicon and interconnect solutions, is positioned at the heart of this spending wave. The company's design pipeline, technology leadership, and customer relationships give it a durable competitive edge. Add to this a healthy balance sheet, ongoing share buybacks, and improving profitability, and you have the recipe for compounding returns. No investment is without risk. Marvell faces strong competition, particularly from Broadcom, which also builds custom ASICs. Further, hyperscalers may decide to design more chips in house. There are also macro risks, tariffs, trade conflicts, or a slowdown in AI capital spending could weigh on the growth of Marvell. However, management has already shown its ability to adapt. By selling the auto Ethernet business, Marvell reduced distraction and sharpened its focus. By diversifying across custom chips, optics, and networking, it has created multiple growth drivers. Even if one area slows, others can offset the impact. So, when markets panic, they often create opportunities. Marvell's nearly 19% drop after quarter 2 earnings is one such case. The company delivered record revenue, record profits, and guided for continued strong growth. Yet, because it did not smash already high expectations, the stock was punished. The reality is that Marvell is performing strongly across its key business segments. Data center sales are soaring, profitability is expanding, and the company is focused squarely on the multi year AI wave. The valuation is at a deep discount compared to peers and history. For investors with a medium to long term horizon, the current price offers an attractive entry point. So, this is the time to be greedy when others are running away. Marvell has positioned itself as a cornerstone of the AI infrastructure build out. The fundamentals remain strong, the growth opportunity is immense, and the stock is undervalued. That combination makes Marvell a good buy after this correction. Thanks for watching. Have a great day.